Let's dive into this whole crypto asset reporting framework thing. It's quite a landscape, especially for investors trying to navigate tax reporting now.
Right? It's like trying to crack a secret code, isn't it?
Exactly. It's a framework that ties into the EU's DAC-8 directive, integrating crypto asset service providers, CASPs, into the tax reporting system by aligning with the OECD's CARF. This is all aimed at creating more transparency.
Yeah, I get that. So, we're talking about making sure every crypto transaction, from crypto fiat exchanges to crypto swaps, is reported, right?
Yep, that's right. And not just the basics. It covers a lot. Think about it. CASPs have to register with an EU member state, and that applies even to non-EU providers serving EU clients. There's a whole registration process, and non-compliance means you could even end up on the ESMA blacklist.
Wow, that's a pretty strong enforcement mechanism. It really forces service providers to play by the rules.
Exactly. And it isn't only about registration. There's a robust set of reporting requirements. CASPs must report crypto to fiat exchanges, crypto to crypto trades, significant retail payment transactions that go over a certain threshold, and also even transfers.
Right?
It's comprehensive data collection in official currencies too.
That's a lot of data to manage. But why all this rigor? Is it just to catch tax evasion?
Well, yeah, kind of. The idea is to improve tax transparency. You see, traditional financial assets are easier to track because they go through centralized intermediaries, but crypto, it's decentralized.
Exactly.
More opaque. So the CARF framework was designed to help tax administrators get a better grip on digital assets.
And CARF stands for Crypto Asset Reporting Framework, correct? How does it really work?
Yep. CARF requires CASPs to collect data on things like account balances, transaction records, and even tax residency information. Basically, it sets a checklist for what they need to report, and then this information is exchanged automatically among tax authorities.
Sounds like a global net. So this is, in effect, an evolution of the Common Reporting Standard.
Absolutely, it's built on similar ideas. The CRS is already used for financial assets, and now crypto assets are being folded in, thanks to CARF, which was approved by the G20 and then published last year.
Right, that's smart. Interesting. And then there's DAC-8, which transposes all of this into EU law, isn't there?
Right, DAC-8 is the legal backbone here. It updates the existing directive on administrative cooperation to specifically include crypto assets, aligning closely with MyKA when it comes to defining what a crypto asset and CASP are. It's very much about ensuring consistency in definition and application across the board.
I'm curious though, how does DAC-8 affect non-EU providers?
Good point. Even if a CASP is based outside the EU, if they serve EU customers, they must register with an EU member state. It's a one-stop registration process, kind of like the DAC-7 model. Non-compliance is taken seriously, which could lead to penalties or even being blacklisted by ESMA.
That makes sense. So it's really an all-encompassing regulatory net, covering everything from crypto exchanges to wallet providers and even NFT marketplaces, correct?
Exactly. It covers all intermediaries, including decentralized protocol developers if they play a role similar to traditional providers. It's sort of like casting a wide net to ensure nothing slips through unnoticed.
Pretty tight regulations indeed. And what about the timeline? When do all these requirements kick in?
Well, DAC-8 will start applying to tax years beginning on January 1st, 2026. But here's the catch. CASPs don't have to file their first report until January 31st, 2027.
Oh, that gives them a bit of a grace period. True, it seems like regulators are giving some time for the industry to catch up with compliance. But I do wonder, is this phased approach truly enough?
That's a good challenge. One could argue it might not be. When you have so many moving parts, different types of transactions, various asset values, it becomes a load to manage.
Absolutely, that could get messy.
However, it also helps spread out the burden.
Right? And with all this data being exchanged between tax authorities, there must be concerns about privacy and data security.
For sure. The framework mandates an electronic, standardized format for data exchange that aims to secure the transmission. Plus, the process respects GDPR. CASPs have to inform their customers before collecting and reporting personal data.
Right, that's crucial. Speaking of customers, The due diligence part sounds pretty intensive. They're required to do self-certification to identify reportable users, right?
Exactly, it's a three-step approach. First, they identify reportable users, then collect and report the information, and finally exchange data with tax authorities through an electronic system. It's thorough, though. It does put additional data collection burdens on CASPs.
That's a lot to handle. And what about transactions like those retail payments? Only those above a certain threshold need to be reported, correct?
Yep, for retail payments made using crypto, only those exceeding a $50,000 threshold need to be reported. The idea is to capture significant movements without overwhelming the system with every minor transaction.
Right, that makes sense. But then how are crypto-to-crypto transactions handled? I imagine those could be tricky.
Definitely, they require reporting both the value of the sold asset and the acquired asset in an official currency. There's also a need to differentiate between incoming and outgoing transactions, and even note special transfer types like
Yeah,
forks
it really does
or
cover all
airdrops.
bases. It seems like the system is designed to leave as little room for evasion as possible. But I have to say, the sheer volume of information being exchanged might put a strain on some providers.
That's a fair critique. It could potentially lead to operational challenges for CASPs, especially smaller ones that might not have the infrastructure to handle such detailed reporting.
I can see that being a real headache.
The rationale is to create a level playing field and foster global tax transparency.
And how does the US fit into all of this? I recall that the US hasn't fully embraced the CRS framework.
Right, the US primarily relies on FATCA for tax information gathering. However, as of AUG 2023, they did propose new crypto tax reporting rules that come into effect on January 1st, 2025.
Indeed, that's interesting.
Even though it's not formally under the CRS umbrella, it might end up with similar outcomes.
So, in essence, even if the US isn't participating in CARF directly, the effect might be similar through FATCA's mechanisms?
Precisely. Non-US exchanges that serve US citizens could fall under these extraterritorial rules. It's a practical convergence, similar to how tax data sharing works in the CRS model.
It's like the best of both worlds, sort of. And what about legacy rules like DAC 7? DAC 8 seems like an upgrade.
Yeah. DAC 8 builds on DAC 7 by broadening the scope to include a wider array of crypto transactions and ensuring alignment with MyCA definitions. It's all about tightening the net for tax transparency in this rapidly evolving crypto market.
Exactly, it's a natural progression. It's a lot to take in, but definitely a necessary step. Investors, especially in the UK and the EU, will need to stay very informed on these changes to ensure compliance, right?
Absolutely. If you're an investor or involved with crypto service providers, you seriously need to understand these frameworks, DAC 8, CARF, and how they interplay with existing regulations like MyKA and CRS. Staying informed means you're better positioned for the tax implications ahead.
For sure, staying ahead is key. Well, it's clear this framework is designed to bring order to the wild world of crypto, and while it might seem daunting at first, it's a big move toward ensuring fair tax practices.
Precisely, and though it might add hurdles for service providers, in the larger picture, it means increased transparency and hopefully a fairer playing field for investors globally.
Definitely a step in the right direction. There's certainly a lot more to watch as these frameworks roll out over the next few years. Thanks for unpacking all this in such detail.
Anytime. It's all crucial info for anyone navigating the crypto world right now. Stick with it and keep on learning. It pays off in the end.
Absolutely.